the last thing to cover here with our trade is going to be, let me see if it works. There we go, the balance of payments. All right. Now, here's the idea behind the balance of payments. When you import goods, dollars leave. They go somewhere else out in the world. But those dollars are not going to be terribly useful out there in the world, right? Because other countries use other currencies. Those dollars are most put to use inside the United States, right, to be able to buy and sell stuff. Okay, so dollars leave. Let's say that you're running a trade deficit. Now, a trade deficit means that you're importing more than you're exporting, right? So if you're importing more value than what you export, that means that you have more money leaving than is coming in. All right. So in this case, a trade deficit means, which is what we run, a trade deficit means that you have more dollars leaving via trade than are able to come in via trade. All right. So what's going to be the result? Well, the result is the money has got to come back to the U.S. in some other fashion. All right, and we're going to look to see what that means, right? How is it that it comes back? Okay, so the balance of payments idea is that you have this money that's coming in and out of the U.S., all right, and between us and the rest of the world, right? The whole ROW, all right? So if money is coming in, and this is what you always want to do when we look at the accounts, we're talking about credits and debits and all that stuff, ask yourself, is the money coming or going? All right. If the money is coming in, that is going to be a credit to that particular account. If the money is going out, that's going to be counted as a debit to that particular account. All right. Always follow the money. Where's the money going? If it's coming in, it's going to be a credit. If the money is going out, it is going to be a debit. All right. So the balance of payments has 3 different accounts. We're only worried about 2 of them for AP macro purposes. We have the current account. We have the capital account or financial account. Now, I'm going to give you both terms here. If you look at older AP macro tests and versions, they refer to it as the capital account. The newer versions, and this is what they use now, is called the financial account, right? I use both in here, but financial account is going to be the term that you see used for this. Okay, and then the official reserves account, and that's the one we don't really care about. It's there, but whatever. All right. And it's double entry bookkeeping, right? When we talk about the balance of payments, the 2 accounts we care about, the current account and then the financial account, have to balance each other. So if one of them is going up, the other one is going down and vice versa. So if the capital account is going up, it's going into surplus. That means the financial account is going down and is going to deficit. Right, now, if the current account is going into deficit, that means the financial account is going into surplus. Right, if one is going up, the other one is going down. So a transaction in one has to be balanced out by payments that are going to be in the other one. All right, and okay, so here's the idea. How about this? Imagine you buy and sell stuff to Kohl's. You sell stuff to the Kohl's department store, and you buy stuff from Kohl's also. All right? So you're trading with Kohl's. Now, as it so happens, you are selling more stuff to Kohl's than Kohl's is selling to you. All right? So you're selling lots of stuff to Kohl's, and Kohl's is paying you in terms of Kohl's gift cards. All right? So you're building up all these gift cards sitting around the house. Now, some of these gift cards you're able to trade in at Kohl's, and you're able to buy stuff at Kohl's, right? But because you're selling more stuff to Kohl's and the other way around, you're never going to be able to use all these gift cards to buy clothes and furniture, and I guess they don't do furniture, right? But housewares, right? And shoes and whatnot. Right, yeah, you can use the gift cards to buy this stuff from Kohl's, but you have far more gift cards than what you have desire to be able to cash in on all this stuff. All right, and they're just building up all the time, right? You're getting even bigger and bigger surpluses of Kohl's cards sitting around your house, right? And they're not worth anything to you except at Kohl's. So what are you going to do with all these excess Kohl's cards? Well, one day you figured out, well, wait a second. Instead of just buying the clothes and whatnot, I can buy floor space at Kohl's, right? So some square footage and some stuff that just stays at Kohl's, right? I can buy clothing racks that the clothes go on. Now I can own those, and I can charge people to put clothes on them, or something like that. All right, and I can buy the bathroom, and I can buy whatever. Or I can even use these Kohl's gift cards to buy stock in the Kohl's company. All right, so. The trade of the goods, right, back and forth, these imports exports you're doing with Kohl's, Kohl's is running a trade deficit with you, right? So they're running a trade deficit, you're running a trade surplus. So you're getting all these excess Kohl's cards built up with you at your home, and you're not going to be able to spend them and cash them in by buying the goods and services from Kohl's, the clothes and the shoes and all that stuff. So you're going to figure out a different way to be able to cash in those Kohl's cards, which is going to be buying the permanent stuff at Kohl's, right? Or buying stock and financial asset at Kohl's instead. So you're going to figure out a different way to use those Kohl's gift cards, right? Now, the same sort of phenomenon works here with international trade. All right, if the U.S. is running a trade deficit, more dollars are leaving than are coming in. Those dollars can't come back in via trade because you're already running a deficit. More is already going out than coming in, leaving all the time. So for foreign individuals, foreign citizens, and foreign companies, they're sitting on these dollars. What are they going to do with the dollars? The ones that they can't use on trade, they're going to figure out some other way to be able to make use of them. And what they'll do is either do a direct investment in the U.S., which would mean, say, buying U.S. real estate or building factories in the U.S., or they can use those dollars to be able to buy U.S. financial assets. Maybe they'll save them in American banks, right? Maybe they'll buy U.S. stocks. Maybe they'll buy U.S. savings bond. Maybe they'll buy U.S. Treasury securities, right? Which means they're loaning the federal government money in exchange for securities, these bonds, right? And so that's a way of cashing in the dollars. So money that goes out one way, in this case via trade, will come back in via another way, which would be in terms of real estate or financial assets. Okay? So if the money is going out in one, the current account, which would be mostly trade, it'll come in via another way, which would be, say, financial investments or direct investments. Okay, so if the money is going out one way, it'll come in another way. So a debit in one will be matched by a credit in the other. All right. So this double entry bookkeeping, right? If one is going up, the other one is going down. So let's say U.S. manufacturer John Deere exports $50 million worth of farm equipment to Ireland. All right, that'd be a credit of $50 million to the current account because for the U.S., because the U.S. is exporting the goods, so you have $50 million coming in, a credit to the U.S. current account, and that'd be matched by a $50 million debit in the financial account. All right, so one is going up by $50 million, the other is going down $50 million. Okay, so the two transactions offset. Yep. Now that third one, we'll get to that here in a second. Okay, so current account. What falls into the current account? It's important to know what goes into the current account, what goes into the financial account. In the current account, this is also known as the balance of trade, right, or net exports. Balance of trade is referring to the imports and exports. Balance of payments is referring to the balance between the current account and the financial account. So the balance of trade or net exports, all right? What falls into this? Exports of goods and services minus the imports of goods and services. All right, so the value of stuff leaving versus the value of stuff coming in. All right, remember, if you're exporting goods, money is coming in, that's a credit. If you're importing goods, money is going out, that's going to be a debit at the current account. Okay, so exports credit, imports debit. Just remember, is the money coming or going? Always think about the money, follow the money. Okay, so balance of trade falls under current account, but that's not the only thing, and that's important. They've had a couple of trick questions in the past where they mentioned this other stuff, all right, because people tend to just focus on balance of trade and net exports as being in the current account, but there's also net foreign income. Okay, so this is income earned by U.S. foreign-owned assets, right, versus income paid to foreign-held U.S. assets. All right. So let's say that, in this case here, let's say that I'm an American citizen and I own some Brazilian bonds, all right? Those Brazilian bonds from the Brazilian government, they pay interest. When I get that interest, when I get the income from those bonds, that falls into the current account, all right? And here, let's say that you have a German citizen who owns U.S. Treasury bonds. When they receive interest on those U.S. Treasury bonds, that money is leaving the U.S. and that'll count as a debit to the current account, okay? But income from foreign-owned assets, right, that's going to be in the current account. It could be interest from bonds. It could be income from factories, something like that, all right? So let's say that I own a factory in Canada. All right, I already own that factory. When I'm getting income from that factory from Canada, that would fall into the current account. And because the money would be going from the Canadian factory to me in the U.S., that would be a credit to the U.S. current account because the money is coming in. All right. So income from these foreign assets counts as current account. Right? You also have net transfers. This is just straight up money movement. All right. So if the U.S. is providing foreign aid to another country, that would be current account. That would be a debit to the U.S. current account because you'd have dollars leaving. Right? It could also be if somebody is sending money to somebody in another country. All right. So if you have a worker who's in the U.S. and they're sending money to, say, family who still lives in another country or extended family, that would be current account. All right. So net transfers of money, just straight up money movement, is going to be current account. Okay, what falls into the capital account or financial account? All right, balance of capital ownership, purchase of real and financial assets, direct investment in the United States, right? So we'll look at examples here. If you buy financial assets in another country, all right, that falls under the financial account. Okay, so let's say those bonds, right? I remember talking about those Brazilian bonds. If I buy if I buy a Brazilian bond, okay, when I buy the bond initially, that would be in the financial account, and that would be a debit to the U.S. financial account because there are dollars leaving and going to Brazil in order to be able to buy that financial asset. Okay. If I were to buy stock in a Brazilian company, that would be in the financial account. I'm buying a financial asset, the money is leaving. Now, when I get income from those financial assets that I purchase, the income is current account, right? But when I buy those financial assets, that is going to be financial account, okay? So the purchase of financial assets is going to be in the financial account, right? Or that Canadian factory that I said that I owned, when I bought that factory, all right, when I bought the factory, that would be in the financial account, okay, because I'm buying a real asset, right, real estate. The real asset is the factory itself, and when I purchased it, there was money leaving the U.S., going to Canada, so that would be a debit to the U.S. financial account, a credit to the Canadian financial account, okay, and when I get income from that factory, the income from the factory would be in the current account. Credit for the U.S., debit for Canada. All right. So the examples here, Warren Buffett buys stock in PetroChina. That would be a debit to the U.S. financial account. You got Warren Buffett dollars leaving the U.S., going to China. Okay. So purchase of domestic financial asset by foreigners represents a credit to the financial account. All right. So if foreigners are buying stuff in the U.S., that's a credit to the financial account. Again, you picture it as dollars are leaving the U.S., foreigners hold those dollars. They can't get it in back to the U.S. to be able to use via trade, so it'll come back in through financial investments. They can buy U.S. stock, buy U.S. treasuries, save it in American banks, whatever happens to be the case. All right, so those would be credits to the U.S. financial account. All right, so debits in the current account, credits in the financial account. Balance each other out. All right. So I'm not going to worry so much about these. Oh, well, now I should a little bit. All right, so what causes capital flows, financial flows, right? Differences in returns on investments. So this has to do with interest rates, which we mentioned in the Forex thing, right? Money will chase higher interest rates. So if interest rates are higher in one country, you'll see more money flowing in the financial account, chasing those higher interest rates. All right, so that sort of thing. All right. All right, so one goes up, the other one goes down, right? Hypothetically, they should zero each other out. Now, in reality, things don't always work the way they should. Theoretically, this is where that third account comes into play, which is made to balance it out. It's an account maintained by the Federal Reserve, but we don't care about that. All right, that official reserves account, never mind. And we don't really care about that either. Okay, now I'm going to give you some scenarios here. I want you to determine if each one of these is going to be in the capital account or financial account. Excuse me, current account or financial account. Right, current account or financial account is going to be a credit or a debit for the U.S. So pause it here, go through each one of those, and determine for yourself which is going to be the case. All right, pause, pause. Okay, supercut. All right, so you went through all the scenarios there. Hopefully you figured out what each one of them were. Let's look at them. All right, so number one, let's fast forward, blah, blah. We already looked at those. Okay, so number one, Bill, an American, invests $20 million in a ski resort in Canada. That is going to be in the financial account, all right? Because he is investing money in the ski resort in Canada. So for the U.S., that is investing in real assets, in this case, real estate. So you have dollars leaving the U.S. and going towards Canada. So this would be financial account, and it would be a debit for the U.S. financial account. And right, number two, a Korean company sells vests to the U.S. military. This would be the current account, because these are goods that are getting traded, right? This would be the vests. And because they're going to be an import, right? So this would be in the current account, right? Import. And since it is an import, this would be a debit for the U.S. current account, right? The vests are coming in, the money is leaving, debit. All right, number three, a U.S. company, Boeing, sells 20 747s to Frost. This would be in the current account. Even though they're very large, it is still a good that is getting exported. And because it is getting exported, that would be a credit to the U.S. current account. Number four, a Chinese company buys a shopping mall in San Diego. Financial account, right? They're buying the mall, the fixed thing, that real estate in San Diego. And so that make it financial account. It's a credit for the U.S., right? Money is coming in order to be able to buy that mall. Number five, an illegal immigrant sends a portion of his earnings to his family. All right, so that would be current account, because we're talking about just straight up money movement, right? Money transfers from one country to another. All right, and that would be a debit for the U.S., a current account, right? So you have money going out. All right, number six, a German investor buys $50,000 in U.S. Treasury bonds. That would be financial account. They're buying a financial asset. It would be a credit for the U.S., right? The money is coming in. And then finally, number seven, Italian tourists spend $5 million in the U.S., while American tourists spend $8 million in Italy. Okay, this would be current account, because this would be money movement, right? Just straight up money going from one country to another one. And for the U.S., this would be a debit, because you have more money leaving the country, going to Italy, right, than is coming back in from the other tourists, right? Italian tourists are spending $5 million in the United States, while American tourists are spending $8 million in Italy. So on balance, you have $3 million more going to Italy than to the U.S. So this would be a debit for the U.S. current account. All right. Now, let's look at a couple of FRQs here. Right? Well, we'll get to that here in a second. But let's say U.S. income increases relative to other countries. The balance of trade moves towards a deficit or a surplus. U.S. citizens, in this case, because they have more disposable income, that means they will import more. Right? If they import more, that means the net exports is decreasing, right? You're importing more and exporting less, which means the current account will decrease, move towards deficit, right? Which is coupled by the financial account moving towards surplus. Okay. Number two, if the U.S. dollar depreciates relative to other countries, does the balance of trade move towards a deficit or surplus? Well, if the currency is depreciating, all right, that means that U.S. exports become more desirable because our stuff is cheaper for other countries to buy. All right. At the same time, other countries' stuff becomes more expensive for us, so we export more, we'll import less because of the weaker American dollar. All right. So the U.S. exports more, imports less, which means that net exports increases. So the current account balance decreases, right? Because the money movement, right? And moves towards a surplus, right? No, currently increases. That shouldn't be decreases. There should be increases. Moving on. All right, here's an actual FRQ that was used in a past test. All right, balance of payments accounts record all of the country's international transactions during a year. Two major sub-accounts in the balance of payments accounts are the current account and the capital account / financial account. In which of these sub-accounts will each of the following transactions be recorded? A United States resident buys chocolate from Belgium. Okay, would that be in the financial account or the current account? Answer, current account, because you're talking about goods that are being traded here, so that would fall under current account. Right, United States manufacturer buys computer equipment from Japan. Where would that fall into? Again, this would be current account, because we're talking about the movement of actual goods and services between countries. B, how would an increase in the real income in the United States affect the United States current account balance? Right, explain. So we just had an example like that, right? So if income is going up in the U.S., that means that we will import more. If we're importing more, that causes the net exports to decrease, right? If net exports is going down, we're importing more than we're exporting. That would mean that the current account balance will move towards deficit because it's decreasing. All right. So you see this question right here, we got a point for saying current, you got another point for saying current, and then you got a point for saying that the current account balance will decrease, move towards the deficit. And for saying why, because increase in income will cause imports to increase. All right. Now this was another FRQ. Suppose that Mexico decreases its tariff rate on all its imports of automobiles from abroad. Will each of the following groups benefit from the decrease in the tariff rate? Mexican consumers, Mexican automobile manufacturers. Explain. All right, so it's decreasing its tariff rates, right? Tariff is a tax on imported goods, so if they're decreasing their tariff rates, okay, will that benefit Mexican consumers? The answer is yes. It doesn't say to explain why, but the reason is because they will have access to cheaper goods than what they did before, right? Because of the cheaper tariffs, right? Now, Mexican automobile manufacturers, will they benefit? The answer is no, because they will be exposed to more foreign competition and cheaper foreign competition than what they had in the past. All right, B, how will the decrease in the tariff rates affect each of the following in Mexico? What will happen to the current account balance? Explain. All right. Well, if the tariff rates are decreasing, that means it's cheaper to import goods from the U.S., so imports for Mexico will increase, which means that net exports is going down, which means the current account balance will move towards deficit. So you would say the current account balance moves towards deficit because imports will increase as a result of the lower tariff rates. All right, and then it's asking what will happen to the financial account. It doesn't say to explain. Your answer very simply is financial account will move towards surplus because we know they go in opposite directions. All right. And then finally, C, given the change in Mexico's current account in B1, what will happen to the aggregate demand in Mexico? All right. So in B1, current account balance, you said it's going to move towards deficit because net exports is going down. How will that affect aggregate demand? Aggregate demand is equal to consumption plus business investment plus government spending plus net exports. So if net exports is going down, the answer here is that aggregate demand will decrease, or we could say shift to the left. So here you see all the answers and what you got points for and how we got there. All right. Yeah, that was 4x we already covered, so that's it.